Hey folks, it's Serge Berger here, and I wanted to give you guys a little bit of a warning message again today. I've noticed that a lot of people have once again gotten very, very bullish here at the upper end of the trading range that we've now reached for stocks. And I just wanted to send you a bit of a reminder. We're going to look at the charts here in just a second, that this is not an environment to, in my opinion, chase stocks and hope for fresh breakouts or fresh sustainable breakouts. In terms of the broader indices, there'll be individual stocks, maybe even a sector or two that can do that. But for the most part, we are in a choppy market environment where the upside is limited as far as I'm concerned, both from an economic growth perspective. There's some structural imbalances, certainly what the bond market is telling us. So I really want to make sure that people kind of heed this call. And you know, we're in a different environment than we were for the past number of years. So let's go over here to the computer and have a quick look at not only what the market rover is telling us, but really just kind of a basic look at the S&P 500. And what you can see here, this is the range of the S&P 500. Maybe if I make this a weekly chart, which is right here, we can see this even better. So essentially, if you really look at this very closely, you can see I drew this red horizontal arrow here, and that basically represents where the stock market has kind of been capped for the most part. We had a bit of a breakout, fake out in September 2018, a bit of a breakout here in the April period of this year, and now we're right back at this area. We had undershooting moves in December, but for the most part, again, you can see we're basically where we were at the top in 2018 or in the early, let's say, January of 2018. And if I look at the market rover, I'm going to quickly flip to this. We are seeing so many parts of the market that are just so choppy right now. You can see at the short-term changes of the sectors, various other gauges that we look at, and the market just doesn't really add up here. Now, what I'll also tell you is that the bond market is telling us a very, very, very different story than what the stock market is doing. And in fact, the bond market, if you were to look at this is bond yields. Bond yields are now back to where they were in August of 2017. So basically, if you take a long-term approach to looking at the bond market, you can see that we essentially had in my opinion, a big breakout, fake-out move here last year, and we're now mean reverting back towards the long-term trajectory of bond yield. So if the bond market is any guidance, and you know, for those of you guys that have followed me for a long time, you know I originally come from the bond market. I think the bond market will usually tell us a better or more accurate signal what's going on, and ultimately the stock market will tend to follow what the bond market is doing. It usually just is a matter of time. That's not to say that the stock market has to totally fall apart here. I just think the upside is very, very limited. And so, you know, my sort of cautionary tone here this morning is not so much to say that you have to short stocks and go crazy in that sense. Just I would be very, very cautious on the upside. From a calendar perspective, and I mentioned this to our clients over the past couple of days, we have the Fed coming out with their next interest rate assessment on the 19th of June. Followed after that, we have the G20. And so the calendar here becomes very, very short from a trading perspective, and I think you know, really the market can go either way. But I think for the most part we're going to just remain quite choppy. And again, I think chasing to the on the upside here is probably the thing to avoid. As always, if you enjoyed this, if you found it helpful, give us a thumbs up, like down below, and or comment if you have any questions. We'll talk to you soon.